Taking a big picture look at the year that was and ahead, of course. Collin Martin, Director and Fixed Income Strategist at Schwab Center for Financial Research, joins us alongside Kevin Gordon, Senior Investment Strategist at Charles Schwab. Great to have you guys both here to take a little retrospective and look forward here. We're so close to ending this year with all-time index records, Kevin. We got for the futures in the NASDAQ, but what's holding us back here just a thread away from the index highs?
Yeah, I mean, it depends on which index you're looking at. If you look at something like the S&P, yeah, you're bumping up against that new all-time high. If you go down the cap scale, you look at the Russell 2000, you're actually, still bumping up towards similar ceilings that you've seen, earlier in the year. And that was sort of the theme for 2023 was, sort of numerous attempts for the market to try to, get sort of find its footing and, find those sources of participation and then move higher. And that was kind of the main theme was that they weren't able to. So, key theme that we're watching for next year, obviously, whether you do start to see, a broadening out in breadth and better participation under the surface, not at the expense, hopefully, of key contributors of the market this year, but hopefully that broadens out and you do get a little bit more of what would be, I guess, considered somewhat of a normal environment.
All right. Normal as defined by rates. Collin, what is that at this point?
Well, we think we'll probably get closer to normal once the Fed starts to cut rates, which we expect sometime next year. We've seen a lot of volatility lately with the treasury market, but as it stands now, coming into 2024, it looks like the next move will be a rate cut. We think 3 rate cuts seem likely, which is a little less aggressive than what the market is pricing in. Markets are pricing in 5 or 6 cuts, which just seems too aggressive given what we see with the economy. Yes, inflation is moving in the right direction, but admittedly, it's still above the Fed's 2% target. But if we take a step back and look at the economy, while we do expect it to slow down from the lagged impact of such an aggressive rate hike cycle, as it stands now, it's still on solid footing. The consumer remains strong. Households still have liquid assets. So until we see, a sharp slowdown maybe on the retail consumer side of the equation, rate cuts might not come as early as some of the markets are expecting. When we do look at the potential for those cuts, we think it's more of a way to really just keep rates in the same level of restrictive as opposed to the need to stimulate the economy. Because if inflation continues to trend lower, that means real interest rates can continue to rise. So rate cuts might just be a way for the Fed to kind of maintain as opposed to stimulate.
Okay. I like that. So having a little lever that goes both ways, perhaps, that seems like it would be a little bit more reasonable than the huge binary pricing of a massive cut series before we get some more information on the economy. The conclusions from both your teams, bonds and stocks, seems to be to stay up in quality for credit and for equity. Kevin, and that seems to come back to your point about the relative performance of quality versus some of those unprofitable small caps and such, because there is still a pretty big difference in how the market has treated quality companies.
Yeah, and it really has to do a lot with the unique nature of this cycle. Typically when you go through a bear market, some form of a recession, you get a reset in the labor market, and you go through that whole sort of washout phase for the economy, and then you start to, see a pretty durable recovery. It's not as clear cut this time because you still have significant weakness in certain parts of the economy, offset by significant strength in other parts of the economy. And sort of the overarching theme or the overarching umbrella for all of that this year has been a relatively resilient labor market. So I mention all that because typically when you do see that bigger reset for economic growth after you come out of a recession, that's typically the time when you've got significant easing on monetary policy and to some extent easing in fiscal policy, and that's when you can move down the quality spectrum because those are the kind of more high beta cyclical parts that are more leveraged to the economy itself. That's not really the case this time, so that's why we've been in this sort of stay up in quality camp, mostly because the expectation, as Collin was sort of mentioning earlier, is not really that the Fed just pivots and cuts aggressively to zero. If we're going to be more in this sort of range of higher interest rates relative to what was the norm pre-pandemic, that's a very different scenario than what many of the younger companies or smaller companies or both have been used to. So that's why the quality trade has worked throughout the past, not just year, but past couple of years, and probably will continue to work as long as you stay in this kind of murkier economic environment.
Okay, like that, because there is still a little bit of murk for us to sift through here. When you look at rates and credit, Collin, the credit market seems very much confident, judging by spreads. Are you even getting rewarded then for going out far on the risk spectrum? How does that look right now in your mind?
We don't think investors are really being rewarded enough to take on those risks. And that's why our theme going into 2024 is that up in quality theme. When we take a look back and when we look at the various parts of the credit market, whether it's investment grade, whether it's high yield, whether it's bank loans, how much we as investors earn in additional yield or spread matters for our outlook. And if we look at pretty much all parts of the market, those spreads are relatively low. Now, the case can be made that they're low for a reason, with the likelihood of a soft landing becoming more likely every day as we get stronger economic releases. But the more those spreads tighten, that means there's just less wiggle room in case growth does slow more than expected, because the lower those spreads go means it just doesn't take much of a spread increase to basically wipe out that spread for the entire course of the year. So for example, if we look at the investment grade corporate bond market, you get an average spread of around 1 percentage point, give or take a few basis points here or there. But with spread so it's tight and the average duration of the index, if that spread rises by just 15 or 20 basis points over the next 12 months, which is certainly in the realm of possibilities if growth does slow, then that can wipe out that spread for the year, and investment grade corporate bonds can underperform treasuries. So as we look ahead, we think positive total returns are likely, but we think it's going to be difficult to actually outperform treasuries, especially if growth slows more than we expect.
Okay. Love that description. Kevin, close us out. Give me an idea of the timeline of when you look ahead, when some of our biggest questions might be answered. Do they kind of coalesce around that expectation for a March cut?
Well, it depends on which question you're looking for. I think that the bigger question in an economic sense is probably whether whether it's different this time in terms of the labor market and the reaction function on the part of the Fed, and whether monetary policy, is actually going to cause a material weakening in labor. And you have to, keep in mind, and we've mentioned this a lot, over the past year, you're really not past the expiration date for when you're supposed to start to see labor weakness in response to a Fed tightening cycle. And not to say that you get some sort of recessionary spike akin to, a drastic recession that we've seen in the past, but it's just whether you see more of an uptick, more than what we've seen in the past few months, with the exception of a little bit of a, rolling over. But I think that that's going to be the main question. Whether it happens in the first or the second quarter, I don't know. But if you get throughout 2024 and you don't get any kind of recessionary spike in labor or in the unemployment rate, then I think, you could probably start to say that the cycle looked entirely different. And despite, all of the tightening from the Fed and, global central bank tightening, it didn't lead to what has historically been a recession.
All right. Nice. That's indeed the question, whether or not we get that big final crack in the labor market. Appreciate the commentary, guys. As always, pleasure working with you this year. Always fun getting your guys' big picture analysis. It's always very useful and helpful. Collin Martin, Kevin Gordon, the Schwab Center for Financial Research.